So let me just go through some of the tickers I have, and you can find perfectly hedging. You know, you can just how to trade volatile markets and all that. These are very important stuff you should know. Okay, so let's start. Right. So I'm going to say this is the strategy for actually volatile markets, the markets which we are going to go through right now. And in general, you can apply this strategy too, right? And the key points to understand is that using options, that's the first thing. So you need to understand options, right? So using options to hedge your portfolio when implied volatility is elevated presents difficulties. Now, that is true. When there's so much volatility, it's difficult to buy options and sell options because you don't know what you're doing. But the whole point is you enter in such a trade that the trade becomes an arbitrage. That means you cannot lose money if it goes either way, right? You end up making money. Now, the upside might not be unlimited, but there's an upside of at least 50%. You should be happy. I'm happy with the upside of 10%, to be very honest, because my bank account pays me 0.05% interest rate, which is next to nothing. And if I can make 10% in one trade, I'm bloody happy, right? Now, investors or people like me and you who are considering hedging should have some experience in options, right? And we're going to learn about calls and puts today. Anybody up here except Ninja and I think Awake and Fade knows options? That people I know of. But anybody else knows options?
Bhavneet's really good at options. Oh, he disappeared.
Yeah.
He left. Oh, I was giving him crap. He's horrible at options. I was kidding.
No, I deal with options, calls and puts, but I tend to do the leaps, the longer term type.
Okay, so you like to rather swing the options to get the speculative trades.
That's correct. I usually let the stock bottom, especially the good one.
Correct.
I traded Intel just late last year when they had that big.
I think I discussed last stream. I discussed my trade which I did with Bank of America, and I made a very good money on it. Yeah, I bought like 70,000 worth of options, 5,000 options contract.
That's a good trade. That's sweet.
Yeah, but so okay, so option. Okay, so this is very much new to me. So let me go to the basics of it, right? And options trading and all that. So this stream might be a little bit longer, but bear with me. So you will love it, to be very honest. Something's happening with my, what the? Can you hear me? Hello?
Yeah, I can hear you.
We can hear you.
I cannot hear you guys. Hold on.
You can't hear us?
No.
Oh.
Hello?
We can hear you.
Okay, let me refresh. Give me a minute.
I'm not doing options, guys. They scare the crap out of me, and I suck at them. I do really poorly with options.
It's not for everybody. I mean,
it scares me. I'll just go to cash this week. From what I'm understanding is I need to just go to cash this week. That's kind of what I'm gathering.
I think if I was going to do options or puts, I would do it for a while using paper trading before I actually put any of my money into it. Try to get a handle on it.
I got my ass kicked with options in December.
Can you hear me now?
Yes, we can hear you.
Okay. Perfect. I can hear you too. Perfect. Something happened there. I could not hear you. Right.
All right.
Let's start with what basics of options, right? So what is an option? Now, if you traded stocks, there's a good chance that you are at least familiar with trading concept of options, right? So options are complex subject but I can help, and it's bloody amazing. So what is an option? Option is, I would say, for example, when you go to buy groceries, right? They sell different groceries, right? So you say, hey, I would like to buy milk, I would like to buy goat cheese, I would like to buy Swiss cheese, and I would like to buy some ricotta, right? So you have options right there. And that's when you look at the stocks, or when you look at the options market in stock market or equities market, to be fair, you have options on ETFs, you have options on currencies, you have options on bonds, commodities, stocks have options, right? There are basically two types of options contract. Option is a contract. It's a contract between buyer and seller saying, hey, if no matter what happens, we agree to do trade on this particular price by this particular date. So each options contract has an expiration, has a strike price, right? And the contract will cost you some money, right? And each contract is made up of 100 shares. That is clear to everybody?
Yeah, I think almost all of us have done options, to be honest, Liam. I think we're pretty experienced with it.
Oh,
some of us just hate it.
I have not.
I know few people who hate options.
But I'd really love to hear your take on how to hedge via options. I mean, that would be awesome.
Right. So what you do is when it comes to hedging your securities against options is you look at your total portfolio value, right? And you look at what market you are trading into. So we are trading into S&P 500 territory, or we are tech heavy, right? So let's say you go and you have 15, or you buy the Liam 100 index, or you buy the Liam Centurion index, right?
Mm-hmm.
You buy that index. My index is innovation heavy, right? That means the ETFs which I represent on the index are ARK ETFs, they are Nasdaq ETFs, and they are innovation ETFs. So just in case if Nasdaq goes up and down 1 to 2%, my portfolio fluctuates 3 to 4%, right? Because I'm more concentrated, more heavy on tech, more heavy on innovation and all that. How can I do something by which, even though my portfolio fluctuates, I can still make money and I cannot lose money, right? What you can do is you can buy the QQQ put options for a longer period of time, or you can buy put spreads. Now, I like to buy put spreads. Anybody familiar with put spread or no?
No, I'm not.
No.
Okay. Ninja, you? I know you trade options.
Yes.
Okay. So walk with me on the options for spread, right? So let's say we look for options chain for QQQ. I'm going to see if I can bring up a chart of option. That would be good. And I'm going to buy options right here.
Can you share your screen, Liam? We're seeing the chart of CDE still.
I'm trying to pull up a chart. I'm trying to pull up the options for QQQ. Hold on. They are not loading. QQQ put spreads. I'll be using Fidelity because I bloody love them for some reason today. Calendar. There you go. Okay, so change the windows. Can you guys see my screen now?
Yes.
Okay. So when you buy a spread, it's called a calendar call in Fidelity. You can use something else, but I like to call it vertical. I like to use I like to also like vertical calls, and I also like to use calendar calls. So let's say you buy a vertical call or vertical put to your QQQ options. What you do is you say, okay, I know QQQ will stay between these two ranges, which ranges, let's say you look on the chart and say, hey, QQQ will stay between 350 and 300. Okay, so what do you want to do now? Well, if the price fluctuates massively between this ranges, I want to safeguard my portfolio. Well, okay, your portfolio is tech heavy. You want to safeguard your portfolio. Very good. Let's do that. We go and we buy. We look at the price range we had. So we had a price range of $5 to $30. Sorry, $50. We go and look for prices of 25, and we look for vertical calls, and we look for all strikes. Now we need to tell ourselves what is the time frame this QQQ will stay between these ranges. So let's say I believe by April 30th, these ranges should be out, right? And I want to buy puts because SPY or QQQ, I expect it to hedge to the bottom rather than hedging towards the top. Okay, let's go and buy a put spread. So let's see, what is a put spread right here? We have a put spread of 310 and 335. Right now, the QQQ is 315, and 335 it could be. So I would go and look for put spread of 313, 310, 335, and I'll say, yes, this is a good put spread. I could hedge my portfolio because the QQQ will stay in between these ranges, and if something happens to it, I would be happy to indulge myself in profit or loss taking measures. So let's model a profit and loss into this trade. So you can see you make money if QQQ goes above or goes below 300. Or you make, and you also make money if you lose money if QQQ goes above 350, right? So your range is perfectly hedged if you're buying puts, right? This is confusing, I know. It's bloody confusing to me sometimes too. But let's look at this point. Let me zoom in.
Totally confused. You've lost me. I think I need to go have dinner and come back when you're talking about metals. I don't understand any of this.
Correct. Okay, so it's a spread. That's what I can tell you. And it's a spread is you're buying one put and you're selling one put. You're shorting one put. That's a spread we are talking about, right? So you are hedging your portfolio in a way that you can only lose limited amount of money, but you can only make limited amount of money. You're not going out naked in the market. Some people like to go naked calls and puts, and that's how they get burned, right? Because they're not hedging their positions. Now, if you look at the table, if the QQQ stays at 314, which is you imagine that it has a more downside and it would stay there, you make no money and you lose your premium, which is $1,300. Now, remember, you only hedge the value of your portfolio in the option. So let's say your portfolio is valued at $15,000. You don't need to buy a big number of options. You can only buy 5 options contract, and you can hedge your portfolio perfectly, right? Because 5 options contract is 500 shares, and 500 multiplied by 300 is roughly around $15,000, which is the value of your portfolio, right? So when people say, "Hey, should I buy $10,000 worth of options?" It's like, no, this is stupidity, right? No, don't do that. Only hedge the value of your portfolio in options. Don't do anything else. You should be ashamed of yourself if you do that. I'm saying out loud in the face. Unless you're an options trader, yeah, then your portfolio, I believe your portfolio should be heavy on options. Let's say your prediction is right and QQQ goes to 300. Well, you will make $400 out of your options, even though your securities went down. You made $400. That means you start to go up somewhere when market starts to go down. Let's say the options contract goes down to 210. You still make $1,000 on it. Imagine you have 5 options contract. You are making $5,000 on that, and your portfolio went down 5,000. That means what? You hedge your portfolio perfectly. Your value of the portfolio remains the same, right? But what you lose is the premium. So if you pay the premium of, let's say, $300 for this options contract, right now the premium is $485 for this options contract. So if you lose that premium, if you don't sell this within the 47 days expiration time, you lose your premium, which you paid for your options contract, right? And that is worth it. That is I would say, expense to do business. If you just, not handling a portfolio actively, you're just hedging it every now and then. That is the cost of doing business. You can do same thing with Spider. So if you look on Spider, you buy one put and you short one put. You can do the same thing. on Spider right there. So let's see, we want to buy calls and puts. We want to buy vertical calls, and we want to buy expiration on April 30th. So where are you, April 30? Right there. And we need to understand, okay, so who is expecting SPY to go, what range the SPY they are expecting? Anybody? From 360 to 400? That's what we're expecting the SPY to go, right?
Right.
So let's say 360, 400, that's a difference of how many dollars? That's $40. So let's say we want an option which is $20 from the value, offset from each other. All right, let's go apply. And we have an option at 400, 420, and then we have an option at 384 at 404, 403, 404. I like the option. Okay, let me make some more strikes. Right. So I like actually the option at 375 and 395. That's the option I like. So I will go and buy a put spread for that. So let's model our profit and loss. Right. So the premium we will pay for this options contract is $578, right? What we are doing is we are buying one put at 395 at $10, and we are selling a put at 375 at $5.23. So overall, you spent $10, you made $5, your total comes out to be $578, right? So your total is $578 of the premium. Let's say this is Spider, this is 394 or 400 multiplied by 400 multiplied by what is the value of your portfolio. Your portfolio is valued at $10,000. You only need to buy 3 options contract for this one. So 400 multiplied by 100 is 4,000. Really 4,000? No, it should be more. 400x 100. It's 40,000. Yeah. So it's $40,000. You only need to buy maybe what? 3 contracts for this to hedge your portfolio's value. And you have 3 contracts, you spend $1,500 on this, you spend 15% of your money, of your $10,000 portfolio to hedge it, right? Now imagine the SPY goes down to the level you're expecting. So let's say the SPY goes down to 350 or 360 level, you will be making $1,000 or $1,100 of this options contract, right? Now imagine your portfolio, you have 3 contracts, your portfolio going down from 10,000 to 7,000, which is 30% decline, by the way, in your portfolio. You hedged it perfectly with 15% of your capital, and you made that 30% decline into growth, right? So when your portfolio will come back, you sell, of course, you sell this options contract at a profit at the time when Spider is around 360, 350, and you get out of this position, you made money because your portfolio stays level, and when your position grows, your positions grows from that bottom, so you end up making more money than losing more money, right? So this is how perfect hedging works. Now, this type of hedging, I like to do spreads because spreads are more safe and less volatile. But what you can do is you can go and buy yourself naked options and naked puts against the securities you own that are called covered puts and covered calls, right? So let's say you own 100 shares of CDE, for example. Well, you don't know what CDE is going to do, if it's going to go down or if it's going to go up. So let me share the screen of CDE chart up here. Change windows and CDE. Okay, everybody can see my chart now. Perfect. So this is CDE 1 year daily time frame, right? And we don't know what CDE is going to do. So we just imagine that, okay, we buy 100 shares of CDE. That cost us around $1,000. Okay, no problem. Let's buy 1 options contract, or maybe 2 options contract, 2 puts, because or you can sell 2 options contract for your CDE position. That's called a covered call. So what you can do is you can sell 1 options contract at a price you want. So let's say you want to sell the CDE option, CDE at around $10.75 or $11. Let's go find ourselves an option for CDE, expiration 11. So I'm going to turn on the options page and then I'm going to share my screen. Options, I want to say calls, strike price strike 20, expiration, volume, open interest, everything is the same. And I expect by April 16, it should go to that $16 level. Not 16, that $11 level. I'm just assuming that price. So look at that. Let me share the screen. So this is CDE, Koei Mining Incorporated. And look at that, $11 call contract. The price of the call contract is 50 cents, right? And I owe 100 shares. What I will do is, I owe 100 shares at what price? Let's say I owe 100 shares at $9. Okay, not a problem. I want to sell this thing at $11. I will go out and hedge my portfolio, hedge my position like this. I will go and sell covered calls on 11 on strike price 11. That is the first way to hedge. So you made $47 of premium. And just in case if somebody wants to buy it from you, they have to pay you $11 for the shares on top of the $47 they already paid you, right? So this is a good deal, not bad. Just in case if the stock goes down, you keep your premium until the expiration, right? So you made some downside to your thing. Another way you can make money.
Liam, let me ask you a quick question on that, because that's really interesting to me. How typically far out, because you'd have to hold this thing until it expires, right? You can't sell your shares until the contract's over. So how long would you typically buy these for? How far out?
So I do this for income purposes. This is my income, right? I get dividend income and I make option premiums. I sell options. Some of you already bought my options on Apple or Google sometimes. I don't own that many shares of Google, but Apple, of course. I sold options on my Apple shares. I sell options on my ARCs. And how this works is you ask a very good question. It's simple. You cannot sell your shares because that's your hedge, right? You're using that as an hedge to sell your securities. You are saying, hey, I have this. I would like to see if somebody wants to buy this at that price by this time. That's what you're doing. So you have a house. You want to sell that by April 30 at $400,000, and I will do a contract. If I have a contract ready, if somebody wants to buy it, I will give you the contract at $500, and you can buy the house whenever you want by April 30. Right? That's what you're doing, and you just need to hold until expiration. You cannot sell it because then you're left naked in the market, and you can lose more money.
Right. So do you typically go about a month out when you purchase these things or sell these things?
Yes. So I like to go around. I think about the price I want to sell this thing, and then I look for the options. So this is I would look at March 19 because if I want to make quick money, but I would look for April 16 or 1 month out if I want to make decent money on my options position, and that's the time I'm holding. So if you're holding CDE for 1 month, right? Look for a 1 month expiration, and you can say, hey, I would like to sell my shares at $12 strike price or $12, but I would like to sell an options contract on that. You go ahead, you do this options trade, you short it. Instead of buy to open, you say sell to open, right? And then you go ahead and you say, hey, this is sell to open. I would like to sell this thing. You don't need to sell this at $30. You can sell it at your own price, right? If the order gets filled, somebody buys your options contract, it's great. But if they are not willing to buy your options contract, you might have to wait. Always put your orders in GTC, good till cancel, right? So it gets filled, right?
I might have you help me with this, walk me through it at some other time, but this is fascinating.
Yep. Like one time, I know when my options contract, or I had an options, and somebody bought my shares at higher price because they saw value and the stock went ridiculous. I forgot which stock it was, but I remember back in 2017 or 18, I had 1,000 shares of a company, and I sold 10 contracts at a strike price where I thought it would be good to sell, and somebody bought it very next day, and the company went haywire after that. So I don't know. It's just bloody amazing. They exercised the options contract, so I had to sell my shares at that price. I made money, of course, but they made even more money than I did.
Right.
Right. So let's say we go and we say buy rather than buying, we say sell. So you can see the graph, it goes inverted, right? So if you don't have, you can only make $25 out of this, right? But if you lose, you can lose unlimited money. Why? Because the price of a stock can go up unlimited. That's why you can lose unlimited money. But if you have shares, your shares are going up with the price, so you don't lose any money at all, right? You
So
just make money.
you'd want multiples of 100 to be able to do this, though.
Correct. You need multiples of 100 to do this.
Okay.
This is the safest hedging you can do.
Yeah, because
On
I'll call option contracts at 100 under each contract. So if you buy one contract, it's automatic 100 shares, basically.
David, do you do this with your portfolio?
I do some options, but I do it slightly differently. I do it based on the value approach, and I tend to take leaps, meaning that I don't play short-term options. I do long-term. So options that I tend to look for is a year or longer. So I look for stock at a good value company at the bottom, and then that's when I enter.
Okay.
And I buy the call usually. I seldom even do puts. I mean, you can in theory. You basically company that at sky high, right?
But you're not selling. You're not buying 100 shares and then selling the option of a I want to say put. Is it a put? Ugh, I can never remember.
Yeah, either way. But no, yeah, I am. I buy calls usually because, and then you sell the call also, right? So essentially, what I do is I buy the call at very low price. It has expiration date, usually a year or longer. I don't like it short term because the shorter the term, the the riskier it is. So what Liam is doing here with the spread is he is basically limiting his loss, his gain or loss, right? But I seldom, use the spread just because I'm lazy. I don't like to think.
I want to try what he's doing because I have 100 shares of a lot of stocks, and if I can sell puts at a higher amount, that means either way I win, right?
Calls, Elise. Calls or puts, depending on where the stock price where the stock price is going.
Okay.
Right. Because it can go either way. It's 50-50, right? Remember, it's and that's the reason why because I don't have since I work full time, I don't have the time to stay on top of it.
Right. No, I get that. So you do the longer out. But Liam, on CDE, right? If I wanted, you said I'd do it for $11.
Yeah.
That means that if it goes down, I keep my shares and I get the 50 cent times, what is it, $50 or whatever it is. But if it goes up and someone exercises, I have to sell my shares at $11, which is a win for me anyway, right?
Right. So let's say if the stock went to $17, right?
Right. I'd have to sell at the 11.
You have to sell at 11, but you still make money.
Okay. Okay. Cool. Well, I think that's awesome. It's a great way to hedge.
Yeah.
But there's also you can buy it back. So if you see like there's really great news about the stock and you don't want to sell it at 11 and they haven't exercised it, you could buy it back, but you'll be paying
a premium at the time.
Again. Yeah.
So if you sold it at 50, but you want to buy it back, you might have to pay more than 50.
Got it. To keep it to go to potentially 17 or whatever we were talking about.
Right. Now, then you enter into a calculation. Then you do a calculation. Hey, is it worth to do that, or is it just worth to keep the money?
I have to leave soon, so I was wondering, can you just quickly? I know that in December you were slowly building oil, right? Because you saw what was coming.
Yes.
And you profited when all of us were dying. You've been profiting.
Yes.
So, I've heard through the rumor vine that you are slowly buying some metals. because you
Yeah.
see something down the road. Can you just quickly let me know which metals I should be looking at and slowly starting to accumulate? Because I
Yes,
don't
you
want to
should.
miss this.
Okay, so you should be looking at hydrogen. Hydrogen is a metal, by the way. If people who don't believe me, come at me.
Is that like F cell and plug?
No, 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 no. So
Okay.
when I say hydrogen, look for the companies which are making hydrogen as a production unit, right? So they sell hydrogen. So look for Linde, LIND. Look for another company which makes gases likewise. So materials companies, right? So hydrogen. That's where I want to buy hydrogen. There's not a hydrogen ETF. That's so silly. Hydrogen is one of the most abundant resources in the universe, but is one of the least abundant resources in terms of gas or pure hydrogen on Earth. And I think rocket scientists in this stream would agree with me, all of them.
So
Right.
you have LIND. Is there any others I should look at?
Others, I'm not at the expense to tell you right now because I'm still researching them fundamentally.
Got it.
Right.
Okay. So just hydrogen in general. Is there anything else I should be accumulating?
Cobalt.
Cobalt.
Rio Tinto is the company I like. I bought them in the COVID crash. RIO.
Yep, my mother used to work there. That's where she's getting her pension.
Yep, I think it's an English company, but people say it's an Australian company, so I don't know. All I care is they pay me 21% dividend once a year, and I'm happy for that fat check.
That's
Wow.
Well,
Okay.
21% to me because I invested
21%
when
dividend.
COVID crash happened.
But
To you, it could be different.
I have a feeling that company is going to get
What about silver? No silver? Gold?
I am not buying silver right now. I don't. I sold my silver positions, some at a profit, some at a loss.
Okay. And then lithium?
Lithium is overvalued, but if you can find, I gave you the company Enovix, ENOVIX. It's going through a spec right now. I published the link in the Liam's patents.
That's right. Are they public?
Hopefully they are. I'm not sure. I'm still researching on the company, but they are. You know, quantum space.
Yes, QS. It's a SPAC.
QS. Correct. This is their competition.
Okay. Okay. Interesting. Okay. So hydrogen and cobalt. So your platinum, palladium, all of these kind of metals you wouldn't really do right now.
No, I'm recommending palladium anytime. Hydrogen and palladium goes hand in hand.
What about PLG? Have you looked at PLG?
Platinum?
No, PLG is in Gary.
PLG.
I used to own that. Oh, it is platinum. Damn it. Never mind. I thought it was palladium. I'm wrong. Sorry.
PALL is palladium.
PALL.
It's physical palladium.
Well, what does that mean? That means like I own physical palladium?
Yes.
But it's an ETF.
Yeah, so they hold it for you. You get the same value as physical palladium. Look at the holding, physical palladium bullion.
And so you estimate that thing's going to rise?
Yes.
Okay.
Yes, absolutely.
Okay.
Look at the 10-year growth of palladium. Look at that.
This guy's from based on his accent. Sometimes it's Indian, sometimes it's Australian.
This is a bloody metal. It went from $47 to $260. This is a metal, not a stock or ARK ETF.
So he's trying to hide himself purposely.
Okay.
I don't know.
Okay.
He just had a weird upbringing.
Oh, Chappie, can you mute? Carolyn, can you mute?
Yeah, I'm trying.
Okay, sorry. All right, so
Weird stuff going on.
You can buy that. You can always buy graphite. Graphite is not a metal, but it has metal-like property.
I already know his first name in the college.
Don't get into miners unless you are so sure about it. Like Rio Tinto is a billion-dollar company. It's multi-billion-dollar company. It pays a good dividend. I received a dividend of $4, I think, recently.
Talking how he talks.
I can vouch for Rio Tinto. It's a huge it's the mine in Utah, the huge copper mine.
Yeah, see, I received, no, I will receive. No, I should be receiving the dividend on 4/15, but I know I got a letter from them. Thank you for being an investor in our company. Blah blah blah. But yeah,
Would it be possible, since you're accumulating this stuff for what you see coming in the pipeline, just to make a list in your Liam's Insights or wherever?
yeah.
Oh, that would be awesome.
Once I'm comfortable with my picks, like, see, I measure my words, every single word I speak, very carefully, and if I don't have trust or belief in it, I would not say it out loud. So the companies I say carry weight, and they carry weight from me. And if you take them and if you suffer a loss, call me, text me, or do something, and we can talk about a plan, right? But
You're awesome.
don't just backhold them like that. I would hate for anybody to do that.
Okay. Well, thank you so much. I'm going to head out, but everybody else is here and they want to learn about options. Options terrify me, but I will get with you because I have 100 shares of some stuff I'd love to learn how to hedge. So thank you.
Yeah.
All right. See you guys.
Right. So we are clear on covered calls and we are clear on spreads, hopefully. Or do you want me to go back on it?
For me, I think it's pretty clear.
Okay. So hopefully I can move on to how to hedge your portfolio in terms of equities now. So when you hedge your portfolio, this is you're hedging your portfolio on a micro level. You're hedging your portfolio with options in a micro level. Let's say you hedge your portfolio on a macro level, right? Macro is a big level where you want to hedge your portfolio. You go and buy. So, for example, if you're afraid of inflation, right? I'm afraid of inflation every single day because we have so much debt outside in the market that I should be afraid of inflation anyway. And inflation is something which is inevitable. Inflation comes every single day. So what you can do is you can put your money somewhere where there is no inflation. For example, gold. There is no inflation in gold. For example, platinum. There is no inflation in platinum. For example, rhodium. These are precious metal I'm talking about. There is no inflation in metals at any time, right? Metals are always inflation proof. They hold their value. They don't deteriorate over the time. Normally, they appreciate over the time, right? For example, if you look at the ETF GLD or S, I like SGOL. I don't like fucking GLD. I like SGOL. And let's look at a 10-year chart of SGOL, or let's say 5-year chart. Look at 5-year chart of SGOL. It went from roughly around $10 to $16 right now. It is a return or cumulative return of 60%. In the same time frame, S&P went up roughly around 54%, right? So S&P has gold has outperformed S&P in the last 5 years, right? Because it's inflation proof, and S&P is not inflation proof. It depends on U.S. economy. It depends on so many factors like PMIs and CFIs, what the non-farm payrolls and all that stuff. There's so many indicators like that which S&P relies on. And look at gold. Gold relies on nothing. It relies on its own bloody value, right? You can look at the same thing with silver because silver is heavily mined. There's demand and supply issues with gold. There's no demand and no supply issues, right? So this is the second way you can hedge your portfolio on a macroeconomic level to save yourself from a safeguard. So let's say if you look at 2-year chart of gold, and we'll go on weekly. Look at 2-year chart of gold. When the coronavirus pandemic happened in March, April, actually gold is the only security which appreciated. This one went from $14 to $19. If you look at GLD, it gave you the similar returns. It gave you similar returns in terms of your performance. It went from $136 to $194, right? And this is something which is very exciting because while the stock market was going down, within 2 days, the gold starts to go up because it's inflation proof, right? And right now it's coming back because the stock market is on the rise, so it's coming back down the portfolio. But imagine you buying gold around that time period. You are appreciating in the value while your stocks are going down, so it's a hedge, right? Gold is a very good hedge. Bitcoin is a very good hedge. So you can look at GBTC. It's a grayscale Bitcoin shares, which is literally Bitcoin in its entirety. And look at GBTC. During the pandemic, it went up, right? It didn't went up drastically, but it went up. And there was a cycle in the GBTC, and it's continued the cycle. The stock went from like $6 to $50 right now. It's fucking amazing, right? It's a commodity. So you take commodities in the value, and you go and hedge your portfolio on it. So let's say you have a $5,000 worth of portfolio, or let's say $10,000 worth of portfolio. A 5% of gold or precious metal is a good combination. It's inflation proof and you can grow, right? So I think that would be all for hedging. This is the only other techniques are complex, and you might not have tools like I might have to. Like you might not have tools to buy credit swaps. You might not have tools to buy mortgage-backed securities. You might not have tools to buy, let's say, an arbitrage trade, right? These are the tools I have access to, which you might not have. So for me, it's not worth it to confuse you further, but to give you a good weapons, which is hedge with options and hedge with gold or precious metals on your portfolio. And you can always hedge with bonds. You can always hedge with bonds. You can use bonds similar to gold. So, for example, if you look at the B and the ETF, so B and the, which is the Vanguard Total Bond Index. And if you look at the 2-year ETF, you can see when it went to around $79 and then it came back again to $88, right? And now it's going down because the bond yields are going down since last couple. Not the This is the treasury bonds. This is not the look at the treasury notes, treasury bonds. This is not the bonds which we see corporate bonds or something like that, right? And they are total 18,000 holdings. Wow, bloody amazing, right? So this is just treasuries. They buy different treasury at different times. But this ETF is going down in last 2-3 couple of weeks. No, it's going down for a long time now. Since January, it's going down. And bond liens are rising. I don't understand why, but it is amazing to see this. It's going down. And this is a good hedge for your portfolio, right? Buying bonds. So normally people say buy 80% stocks, 20% bonds. I say buy 70% stocks, 10% of your precious metals and options, and 10% of your bonds, and keep 10% in cash. That's what I tell them, right? So that's the bonds. As you can use bonds as hedge. Most of the bonds are not inflation protected, but they give you a good dividend yield, so your dividend can offset your income. Like they are paying you every single quarter. Look at that. So that is just bloody amazing how they go through it. I'm open to questions with you guys. If you have something to talk about, yeah, feel free to do that. I would love that. And I apologize for today. I really do, from bottom of my heart. It just fucking daylight savings time. I killed my schedule.
Yeah, I think it does it to everyone.
Yeah. Okay, Chappie, Danielle, Dog, Fade, never mind, Ninja, and Stefan. How can I help, mate? How can I?
Ethereum's another good one, right? ETHE, to hedge against along with GBTC.
Could you repeat yourself, Ninja, please?
Ethereum.
Oh yes,
the
ETH.
Grayscale, yeah. So ETHE.
Oh yeah.
That's another one, a good one to kind of ride the crypto with.
Right. Yeah, that is absolutely true. Grayscale Ethereum Trust. I never knew about it. I only invested in GBTC when around when Bitcoin was around $9,000, $10,000 level. So I 5x'd my money there, but that was all.
Oh, I just found out about both of them about a month ago, so I got in.
Amazing, bloody
Yeah.
amazing. I don't know. I don't like cryptocurrencies. I like the idea behind it, decentralized system. I just don't like cryptos. So if somebody comes tomorrow and starts backing it, I'm going all crypto, all bloody crypto.
I don't like Bitcoin.
Yeah. Hey, have you seen that video from that Dan Penna?
I can't say that I have.
Probably he says Bitcoin. Putin is behind Bitcoin. He's going to kill you and all that stuff. Bitcoin is for morons and all that. He's ranting the shit out of people. I don't like the guy anyway. He's a bully.
I, I don't have any issues against the concept that is Bitcoin, but Bitcoin was built as a proof of concept. It doesn't really offer any service or it's not something that I see to have value other than the fact that a bunch of people see that it has value. Now, other coins like Ethereum that is contract based, that actually has it adds value to the world. Bitcoin doesn't do those sorts of things.
But Bitcoin is the chosen one. Bitcoin is the first baby. It's
Right.
Adam and Eve.
I think at some point though there's going to be a realization that the Bitcoin doesn't really do anything, and it's just a proof of concept. But there are a ton of other coins out there that actually do provide something that has value. Transaction times between banks from I mean, right now, if you were to wire money to another country, it's actually faster for you to get on a plane with that cash and deliver it in person than it is to wire it through the banking system.
Oh, really?
Yeah, it's super slow through banking systems. Most of the time, it's
One time, Charles Schwab wired me money in Sao Paulo within 22 minutes.
right. So it's not actually that money getting from one bank to the next.
Oh,
It's more like a trust between two banking sources.
oh, okay, okay. Now I get you because I was understanding. Okay, yeah, because banking system works on Hawala system. So Hawala system.
I can't say that I do.
So it's a system built on trust. So you go to your place. Let's say if you live in Michigan, you go to Michigan and you say, hey, I would like to send a wire within 1 hour to Texas. Okay, so you go to a place called a bank, and then you say you want to do a wire. So what the bank does, bank will say, hey, okay, deposit money right now, and then they will call the other bank in Texas saying, we got the money, you can release the money, and they will deal with the money on their own.
Right, and
Right?
that's an issue that some crypto coins fix. I mean that the valued item is transferred
Yeah,
to anywhere in the world within a fraction of a second.
very much true. I support your idea of Bitcoin. Yeah, it's a proof of concept, nothing else. It's just Adam and Eve. That's all.
Right. I don't know when it's going to happen, but I do believe that at some point Bitcoin will be seen as worthless. It may take 100 years. I don't know.
Yeah, you're not related to that Pena guy, right?
No.
Okay, just to make sure because he's a bloody bully. If he comes after me, I'm punching him in the face. But yeah, this is amazing, and I don't know. I feel like I was able to send out what I intended, but I'm just here to take questions and talk.
I did have some questions on that at a web scraper. It's really what it is.
Yeah.
Um, Now these weighted tickers, say
Mm.
the three of the ETFs contain Tesla.
Yeah.
The I guess the biggest question I have is when you are saying multiply by 0.1, if you multiply it at the time of coming across that ticker, and then you come across it again and multiply it by 0.1, then the result is going to be different if you wait to do the multiplication and you add the weights and then do the multiplication at the end.
Yeah, I understand that. And I think you got the concept right, but you got the math, the way to do math wrong in my opinion. So if you let me open up the index on my page, Excel Liam Centurion Index. Were you able to get those Chinese stocks in the portfolio?
I haven't added those yet, but I'm definitely going to run it through the website that I'm scraping from.
Okay. Are you escaping from Bloomberg?
I'm scraping from, let me open the solution here. I'm scraping from finhub.io.
Okay.
They have a paid API, but they also have an error on their website. It's basically, it's kind of using something called SQL injection, where you just break their site to dump all the information that it has.
Yeah.
So I was able to get around the paid API.
Oh, that is bloody amazing, dude. I like you so much.
I don't want to pay for information that's free.
Yeah, same here. That's what I think. Can you see my Excel sheet or no?
Yeah, it's loading for me. It's kind of going in and out.
Okay, now it should stay. Let me refresh my Discord. Hold on. Control R. Oh, it should be fine. Let me share my screen. Can you see it now?
It's doing the same thing.
Oh, I don't know why then. But these are the stocks I want in my index. And I was able to get the volume trends and what the volume is. And my index is volume weighted. So now I figured out the way around that multiplication factor I had.
Okay.
So now you can make it price weighted and volume weighted, right? So if you watch the video I sent out to you, I think, or maybe in the group. I don't know if it was in the group or maybe it was in uh, where I'm not sure where it was, but
I know
I
you
sent out.
sent out several videos.
But no, one where the guy is talking about price calculation. Let me see if I can share my YouTube.
Is it this Mithril Money channel?
Yes, Mithra. Yes, yes,
Okay.
yes.
Daddy company.
Because he calculates the index, and I want to calculate the index the way he does because that's price weighted index is I think it's best way to go. Wait, are you in the stream?
Yeah.
Okay.
Yeah, I had the video. I can watch it and model something after it.
Yeah, and I only need those 250 stocks I shared in my Excel sheet with you. as a part of my index. And if you will weight them according to the guy's weighting, we should be fine without using the multiplication factor.
Okay, so those stocks that you sent in the spreadsheet, you want those regardless